Log-normal distributions and simulation techniques introduces statistical models used to analyze financial asset prices and evaluate uncertain investment outcomes. The topic explains that financial analysts often rely on probability distributions and simulation methods to estimate future market behavior. Because asset prices cannot fall below zero and frequently exhibit compounding growth, traditional normal distributions may not accurately describe their behavior. The topic therefore focuses on log-normal distributions, which better capture the characteristics of asset prices over time. In addition, simulation techniques such as Monte Carlo simulation and bootstrap resampling are introduced as practical tools for modeling uncertainty, forecasting outcomes, and supporting investment decision-making under complex market conditions. The topic begins by explaining the relationship between normal and log-normal distributions. Continuously compounded asset returns are often assumed to follow a normal distribution because returns can be positive or negative and are mathematically convenient for statistical analysis. However, asset prices themselves are modeled using a log-normal distribution because prices cannot become negative. Under a log-normal distribution, prices remain strictly positive while still reflecting the effects of compounded returns over time. The topic emphasizes that if continuously compounded returns are normally distributed, the resulting future asset prices will follow a log-normal distribution. This relationship is fundamental to modern financial modeling and derivative pricing theory. The topic highlights several important properties of log-normal distributions in finance. Log-normal distributions are positively skewed, meaning they have a long right tail representing the possibility of large positive price increases. Unlike normal distributions, they prevent impossible negative price outcomes while still allowing significant upside potential. These characteristics make log-normal models more realistic for describing stock prices, commodity prices, and other financial assets. The topic also explains that continuously compounded returns can be added across periods, simplifying calculations involving multiple time horizons. This mathematical convenience contributes to the widespread use of log-normal assumptions in portfolio management, option pricing, and risk analysis. A major focus of the topic is Monte Carlo simulation, a computational technique used to model uncertain financial outcomes by repeatedly generating random scenarios. Monte Carlo methods simulate a large number of possible future paths for asset prices, returns, or economic variables using probability assumptions. Analysts then evaluate the distribution of outcomes to estimate expected returns, risks, and probabilities of different events. The topic emphasizes that Monte Carlo simulation is especially useful when analytical solutions are difficult or impossible to derive mathematically. Applications include portfolio risk analysis, retirement planning, derivative valuation, project evaluation, and stress testing under varying economic and market conditions. The topic also introduces bootstrap resampling, a simulation technique based on observed historical data rather than theoretical probability distributions. In bootstrap methods, analysts repeatedly draw random samples from existing datasets with replacement to generate simulated return scenarios. This approach preserves many characteristics of actual market behavior, including volatility patterns and empirical return distributions. Bootstrap resampling is valuable when analysts prefer not to rely heavily on strict distributional assumptions such as normality. The topic explains that bootstrap methods are commonly applied in portfolio analysis, performance evaluation, and risk management because they provide flexible ways to estimate uncertainty using real-world historical observations. The topic emphasizes the practical importance of simulation techniques in modern investment analysis. Financial markets involve numerous interacting variables and uncertain outcomes that cannot always be evaluated through simple formulas. Simulation methods allow analysts to model complex systems, assess probabilities of extreme events, and evaluate alternative investment strategies under many possible scenarios. Monte Carlo simulation and bootstrap resampling improve decision-making by helping investors understand the full range of potential outcomes rather than relying solely on single-point estimates. These methods are widely used by portfolio managers, risk analysts, actuaries, and financial institutions to support strategic planning and quantitative risk management practices. The key concepts from topic establish an important quantitative framework for analyzing uncertainty in finance. The topic demonstrates why log-normal distributions better describe asset prices than normal distributions and explains how continuously compounded returns support this modeling approach. It also introduces simulation techniques that allow analysts to estimate portfolio outcomes, evaluate risk exposures, and forecast financial scenarios under uncertainty. Monte Carlo simulation and bootstrap resampling provide flexible tools for addressing complex financial problems that lack simple analytical solutions. Mastery of these concepts strengthens quantitative reasoning skills and prepares CFA candidates for advanced applications in portfolio management, derivatives, financial engineering, and enterprise risk management.